We've all been there, working hard, juggling bills, and feeling like no matter how much we earn, we just can't get ahead. It feels like financial freedom is a distant dream. We all want big financial wins. But what if I told you that the key to wealth isn't necessarily in the massive jackpot, but in small, consistent wins? It's easy to get caught up in the idea that you need a huge salary or investment to make a real impact on your finances, but that's not the case. Passive income, specifically through dividends, is all about making small, smart moves that build over time. You don't need to start with a fortune. Whether it's $50, $100, or $500 a month, it all adds up. And eventually, it snowballs. In this video, I'll show you and Josh exactly how to start building your own passive income streams, even if you're starting from scratch. I'll show you how to make your money work for you step by step. I will show you how to select Buffett criteria stocks in minutes, and in the end, I will show you a $9 per day investment plan into a portfolio that can grow into a $2.5 million valuation and pay $5,000 per month in dividend income. So grab a pen and paper, sit back, and let's get into it. Why it matters. Relying only on a job is risky. Companies lay off workers, economies shift, and inflation slowly eats away at savings. Even if you're a disciplined saver, growing wealth fast enough to keep up with rising costs is tough. That's where passive income steps in. It keeps paying you even when you're not actively working. One of the most powerful tools for this? Dividend stocks. These are shares of solid, well-established companies that pay you a piece of their profits regularly. And here's the magic. If you reinvest those dividends, they start earning money too. Over time, this compounding effect turns small investments into significant wealth. The best part? You don't need thousands to start. You can begin with just a few dollars and let time do the heavy lifting. Whether you want to supplement your income, save for retirement, or gain financial freedom, passive income gives you options and control over your future. The sooner you start, the more your money can grow. My goal for this video is simple: to arm you with the tools so that by the end, you will be able to start investing and select stocks for your own portfolio that can turn a $9 daily investment into a $2.5 million portfolio and generates $5,000 in monthly dividend income for retirement. So, let's understand the basics of stocks. Stocks are one of the most effective tools for building wealth and generating passive income. At their core, stocks represent ownership in a company. When you purchase a stock, you become a partial owner of that business, giving you a share in its earnings. This success can come in two primary forms: capital appreciation and dividends. Capital appreciation occurs when the value of the company, and therefore the price of the stock, increases over time. For example, if you buy a stock for $50 and its price grows to $100, your investment has doubled in value with capital appreciation, totaling $50 extra. Dividends, on the other hand, are payments made by companies to their shareholders, typically as a portion of their profits. These payments, which often occur quarterly, provide a steady income simply for holding the stock. Stocks are traded on exchanges like the New York Stock Exchange or NASDAQ, where buyers and sellers interact to determine stock prices. The value of a stock fluctuates based on supply and demand, which are influenced by factors such as the company's financial performance, market trends, and investor sentiment. While these price changes can create opportunities for growth, they also introduce risks. The market is inherently volatile, which means prices can drop unexpectedly. However, for long-term investors, this short-term volatility often smooths out, allowing the potential for steady gains over time, something I will show you later on. Dividend-paying stocks are particularly appealing for building passive income. Dividends are not only a reward for owning shares, but also a powerful tool for compounding wealth. Companies that pay dividends are often financially stable and established, making them attractive for those looking to generate income. Many of these companies also have a history of increasing their dividend payouts annually, meaning your income can grow over time without additional investments. This concept of dividend growth is essential for building long-term wealth, as it ensures that your passive income keeps up with inflation and continues to increase in value. Reinvesting dividends is one of the most effective ways to accelerate the growth of your portfolio. Instead of taking the dividend payouts as cash, reinvesting them allows you to purchase additional shares of the same stock. This creates a compounding effect where you earn dividends on the dividends you've reinvested. Over time, this snowball effect significantly increases both your portfolio's value and the income it generates. The longer you allow this process to work, the more powerful the results become. To see the potential of dividend investing, let's consider a real-world example. If you invest $10,000 in Prologis Incorporated, a dividend-paying stock with a 3.17% dividend yield and an average dividend growth rate of 11.27%, over 30 years, that investment grows substantially. After the first year, your portfolio increases to $11,000, earning $300 in annual dividends. After 10 years, it grows to $35,000, generating $1,100 in dividends annually. By year 30, your portfolio reaches $484,000, and your annual dividend income climbs to $19,600, or approximately $1,600 per month. This growth is the result of combining dividend reinvestment with the stock's price appreciation and annual dividend increases. What starts as a modest investment evolves into a substantial income source over time thanks to the power of compounding. In the end, I will show you a portfolio of stocks that will help you reach a $2.5 million valuation and earn $5,000 in monthly dividend income, all with just a $9 per day investment. One of the best aspects of dividend investing is its accessibility. You don't need to be wealthy to get started. Many brokerages allow you to invest in fractional shares, meaning you can begin with as little as $5 or $10. The key is consistency. Regularly adding to your investments, reinvesting dividends, and giving your portfolio time to grow. While the returns may seem small initially, the compounding effect magnifies those results exponentially over the years. Dividend investing is not about trying to predict market movements or chase high-risk gains. Instead, it's about focusing on quality companies with a history of paying and growing dividends. These stocks provide a consistent income stream even during market downturns and offer the opportunity for long-term growth. By understanding how stocks work and how to leverage dividends effectively, you can create a reliable strategy for building passive income. This foundational understanding of stocks, what they are, how they generate income, and how to harness their potential lays the groundwork for a successful investment journey. But before searching the stocks, let's understand the stock market mechanics. Let's start with ticker symbols, which are an essential part of the stock market. They serve as short codes or nicknames used to identify companies. For instance, Home Depot's ticker symbol is HD, and Coca-Cola's is KO. These abbreviations are found everywhere, from broker platforms to financial news sites, making it easier to locate and track specific stocks without typing out the company's full name. Every time you search for a stock, you'll rely on its ticker symbol to pull up the relevant information quickly and efficiently. Once you've identified a stock, the next step is understanding how to buy or sell it. This is where market orders and limit orders come into play. A market order is the simplest and fastest way to execute a trade. It allows you to buy or sell shares immediately at the current market price. This speed and simplicity make it a popular choice for many investors. However, because market prices can fluctuate quickly, you may end up paying slightly more or selling for slightly less than you initially expected. These small discrepancies happen because the market matches your order with the best available price at that moment, which might shift as your order is processed. Limit orders, on the other hand, provide more control over the price at which you buy or sell. With a limit order, you set a specific price, and the trade will only execute if the stock reaches that price. For example, if you want to buy shares of a stock but only if its price drops to $50, you can place a limit order at $50. If the stock's price doesn't reach your target, the trade won't go through. This precision can be advantageous, especially when you're looking to avoid overpaying or underselling. However, limit orders require patience, as there's no guarantee the stock will hit your desired price. It's a trade-off between control and immediacy, and the choice depends on your investment strategy. Another critical concept in the stock market is understanding bid and ask prices. When you look up a stock on your broker's platform, you'll see two numbers, the bid and the ask. The bid is the highest price that buyers are currently willing to pay for the stock, while the ask is the lowest price that sellers are willing to accept. The difference between these two numbers is known as the spread. The size of the spread can provide valuable insights into the stock's liquidity and how easily it can be bought or sold. A narrow spread usually indicates high liquidity, meaning there are many buyers and sellers actively trading the stock. This makes it easier to enter or exit a position without significantly impacting the price. Stocks of large, well-established companies like Apple or Microsoft typically have tight spreads and high liquidity because they are frequently traded. Conversely, a wider spread may suggest lower liquidity, which can make it harder to execute trades without affecting the stock's price. This is more common in smaller or less popular stocks where trading activity is lower. Understanding these dynamics is crucial for navigating the stock market effectively. These tools allow you to tailor your trades to your goals, whether you prioritize speed, precision, or cost efficiency. For instance, if you're investing in a stock with high liquidity, a market order might be the quickest and easiest option. On the other hand, if you're targeting a specific entry point or trading a less liquid stock, a limit order provides the precision needed to optimize your trade. These decisions are not made in isolation. The type of order you use and the stocks you choose depend on your overall investment strategy. Factors such as your financial goals, risk tolerance, and market conditions play a role in shaping these decisions. For example, long-term investors who prioritize consistency and stability might focus on highly liquid stocks with narrow spreads, while more opportunistic traders may use limit orders to capitalize on short-term price movements. The stock market is built on a series of interconnected mechanics, each designed to facilitate the buying and selling of shares. By understanding ticker symbols, order types, and bid-ask dynamics, you gain the knowledge to make informed decisions. This foundation prepares you to dive deeper into stock analysis and investment strategies, allowing you to confidently navigate the market and work toward your financial goals. Key ratios and metrics for analyzing stocks. However, investing in the stock market isn't just about buying shares of a company and hoping for the best. To make informed decisions, you need to understand how to evaluate a company's financial health and growth potential. This is where key financial ratios and metrics come into play. These tools give you insights into a company's performance, allowing you to determine whether it's a worthwhile investment. Later on, we will show you how Buffett uses these tools to find stocks for his portfolio, and I will also show you a real-life stock and create a portfolio using Buffett's criteria. One of the most commonly used metrics is the price-to-earnings, or PE ratio, which measures how much investors are willing to pay for a company's earnings. It's calculated by dividing the current stock price by the company's earnings per share, or EPS. A high PE ratio might indicate that investors expect strong future growth, while a low PE ratio could suggest the stock is undervalued or that the company faces challenges. However, the PE ratio should always be compared to other companies in the same industry for context. For example, a tech company will typically have a higher PE ratio than a utility company due to its growth potential. Another critical metric is the dividend yield, which measures how much income you can expect from a stock in relation to its price. Dividend yield is calculated by dividing the annual dividend per share by the current stock price. For example, if a company pays an annual dividend of $2 per share and its stock price is $50, the dividend yield is 4%. Dividend yield is especially important for investors focused on generating passive income. A high yield can be attractive, but it's essential to ensure the company can sustain its dividend payments over the long term. Don't chase overly high dividend yields like 10% or 15%. These are usually dividend traps, and companies typically cannot sustain these inflated dividends for long. A good rule of thumb is to avoid yields over 6 to 7%. The debt-to-equity, or DE ratio, is another important tool for analyzing a company's financial health. It measures how much debt the company has relative to its equity and is calculated by dividing total liabilities by total shareholder equity. A lower DE ratio is generally preferred as it indicates the company isn't overly reliant on borrowing to finance its operations. However, some industries, like utilities, naturally have higher debt levels, so it's crucial to consider the context of the sector when interpreting this metric. Return on equity, or ROE, is a measure of how efficiently a company generates profits from its shareholders' equity. It's calculated by dividing net income by shareholder equity. A higher ROE indicates that the company is effectively using its resources to generate profits, making it an attractive investment. Like the PE ratio, ROE should be compared within the same industry to assess how a company stacks up against its competitors. The earnings per share, or EPS metric, is a snapshot of a company's profitability. It's calculated by dividing the company's net income by the number of outstanding shares. EPS is a straightforward way to evaluate a company's earnings power on a per-share basis. Companies with consistently growing EPS are generally seen as strong investments, as it reflects their ability to increase profits over time. While these ratios provide valuable insights, they shouldn't be used in isolation. Combining multiple metrics paints a clear picture of a company's financial health. For example, a company might have a high dividend yield, but if its DE ratio is also high, it could indicate that the company is using excessive debt to maintain its dividend payments. Similarly, a low PE ratio might suggest that a stock is undervalued, but it could also be a sign of underlying problems within the company. To make analyzing these metrics more accessible, there are tools and platforms like Seeking Alpha, FinChat, Yahoo Finance, Morningstar, and brokerage platforms that offer detailed financial data for stocks. These resources often present ratios and metrics in an easy-to-read format, allowing you to compare companies and track trends over time. For instance, you can use these tools to see how a company's PE ratio has changed over the years or to monitor its dividend growth history. Another important consideration is how these metrics vary across industries. For example, tech companies often prioritize growth over dividends, so their PE ratios will be higher and dividend yields lower. Conversely, utility companies are known for their stable dividends and lower growth rates, making metrics like dividend yield and DE ratio more relevant when evaluating them. Understanding these industry-specific nuances can help you better interpret financial data and make more informed investment decisions. As you begin analyzing stocks, keep in mind that no single metric tells the whole story. A company with a strong PE ratio might look appealing at first glance, but if its DE ratio is high and its ROE is weak, it could be a risky investment. The goal is to look for companies with a balanced financial profile, strong profitability, sustainable debt levels, and a history of rewarding shareholders. Right now it might sound confusing, but in a couple of minutes, I will explain with a real stock and you will see how easy it is to follow. Stick around. Analyzing stocks using these key ratios and metrics is a critical step in building a solid investment strategy. By understanding how to interpret this data, you'll be able to identify companies with strong fundamentals and avoid those that might pose unnecessary risks. This approach not only helps you make smarter investment choices, but also gives you the confidence to navigate the stock market with a long-term perspective. Now, let's understand the economic sectors. The stock market is vast, and understanding economic sectors is essential for navigating it effectively. Economic sectors group companies based on the type of business they conduct or the industry they operate in. This classification helps investors diversify their portfolios and identify opportunities across different areas of the economy. By knowing how sectors perform during various market conditions, you can make more informed decisions and reduce overall investment risk. There are 11 primary economic sectors, each representing a distinct area of the economy. These include technology, healthcare, consumer discretionary, consumer staples, energy, financials, industrials, materials, real estate, communication services, and utilities. Each sector plays a specific role in driving the economy, and their performance can vary depending on factors like economic cycles, government policies, and technological advancements. For instance, the technology sector, which includes companies like Apple and Microsoft, tends to thrive during periods of innovation and consumer demand for digital products and services. Meanwhile, sectors like utilities or consumer staples, companies providing essential goods and services, often perform well during economic downturns because they supply necessities that people continue to purchase regardless of financial conditions. One of the key reasons to understand sectors is to achieve diversification. Diversification involves spreading your investments across different sectors to reduce the impact of poor performance in any one area. For example, if you invest heavily in technology stocks and the sector faces a downturn, your portfolio could take a significant hit. However, if your investments are also spread across sectors like healthcare, energy, and utilities, the losses in one area will be offset by gains in another. Diversification helps stabilize your returns over time and makes your portfolio less vulnerable to market volatility. Sectors are also categorized based on how they respond to economic conditions. Cyclical sectors such as technology, industrials, and consumer discretionary tend to do well when the economy is growing. These sectors are highly sensitive to consumer spending and economic activity, which means their performance often mirrors the health of the economy. During periods of economic expansion, cyclical sectors see increased demand, higher revenue, and rising stock prices. However, during recessions, these sectors are often hit hardest as consumer spending declines. On the other hand, defensive sectors, such as healthcare, utilities, and consumer staples, are more stable and less affected by economic cycles. These sectors provide essential goods and services that people need regardless of the economic climate. For instance, consumers will continue to buy groceries, use electricity, and seek medical care even during a recession. As a result, defensive sectors are often seen as safe havens for investors during periods of economic uncertainty. They may not deliver rapid growth like cyclical sectors, but they offer consistent performance and steady returns, making them valuable for risk-averse investors. Sector-specific investing can also help you align your portfolio with your financial goals and risk tolerance. If you're seeking long-term growth, sectors like technology and healthcare may be attractive due to their innovation-driven nature and potential for high returns. For example, advancements in artificial intelligence or biotechnology could lead to significant growth in these areas. Conversely, if you prioritize income and stability, sectors like utilities and consumer staples are worth considering because they often feature companies with consistent dividend payouts. Understanding sectors also allows you to capitalize on trends and shifts in the economy. For example, the energy sector has experienced significant changes with the rise of renewable energy and the global push towards sustainability. Investors who identify these trends early can position themselves to benefit from long-term growth opportunities. Similarly, the real estate sector, which includes real estate investment trusts or REITs, provides an opportunity to invest in income-generating properties without directly owning physical real estate. While investing across sectors offers diversification, it's important to monitor how your investments perform over time. Economic conditions and market dynamics are always changing, and some sectors may become more or less attractive depending on the environment. Regularly reviewing your portfolio and rebalancing as needed can help you maintain an optimal mix of investments that aligns with your goals. For example, if you notice that a cyclical sector like technology has grown disproportionately in your portfolio due to strong performance, you might consider trimming your holdings in that sector and reallocating to defensive sectors like healthcare or utilities. This ensures that your portfolio remains well-balanced and protected against potential downturns. Understanding how sectors operate and respond to market conditions can help you build a more resilient portfolio. Whether your focus is on growth, income, or stability, a sector-based approach allows you to allocate your investments strategically to achieve your financial goals. Diversification across sectors not only reduces risk, but also positions you to benefit from opportunities in different areas of the economy. But for that, planning is a must, so let's understand the planning for market swings. The stock market is unpredictable, filled with corrections, recessions, and bear markets. These swings may seem alarming, but they are temporary. Over time, markets recover and often grow beyond their previous highs. This recovery is the cornerstone of long-term investing. It's not about predicting when the next dip will happen. It's about having a strategy, staying consistent, and making volatility work in your favor. Emotions can be an investor's worst enemy during market highs and lows. When the market is climbing, it's easy to chase rising stocks out of fear of missing out, often buying at inflated prices. Conversely, when markets fall, panic often leads to selling at a loss, locking in what might have been a temporary decline. The key is to remain rational and avoid reacting emotionally. Long-term success in investing comes from keeping your focus on your strategy and resisting the urge to follow the crowd. A strong defense against volatility is a well-diversified portfolio. By spreading your investments across various sectors and asset types, you reduce the impact of any single investment's poor performance. For example, pairing growth stocks with dividend-paying stocks and bonds creates balance. When a high-growth stock in the technology sector experiences a downturn, the steady income from dividend stocks or the stability of bonds can cushion your portfolio. Diversification ensures no single event derails your overall investment plan. Another powerful strategy for managing market swings is dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. Instead of stressing over the perfect time to invest, You invest a fixed amount at regular intervals, regardless of market conditions. This strategy helps you buy more shares when prices are low and fewer shares when prices are high, which averages out your cost over time and reduces risk. For example, let's say you invest $200 every month into a stock. In month 1, the stock price is $50 per share, so you buy 4 shares. In month 2, the stock drops to $40 per share, so you buy 5 shares. In month 3, the stock rises to $66 per share, so you buy 3 shares. Since you're buying at different prices, your average cost per share is lower than the highest price you paid. Instead of dumping all your money in at once and risking a bad price, DCA smooths out the ups and downs, keeping your investment steady and reducing market stress. But managing market swings isn't just about keeping emotions in check, it's also about overcoming analysis paralysis. With so much information available, it's easy to get stuck researching and second-guessing every decision. You might spend hours reading about stocks, strategies, and trends, but hesitate to make a move. Perfect knowledge doesn't exist, and there's always some level of uncertainty in investing. The solution is simple. Start small. Making your first investment, even if it's just $10, is more valuable than endless research. Taking action builds confidence, and as you gain experience, you'll develop a better understanding of markets and patterns. Small, consistent actions are the foundation of successful investing. Think of it like building strength in the gym. You don't start with the heaviest weights. You begin with manageable ones and gradually increase as you build confidence. Investing works the same way. Starting small allows you to learn without feeling overwhelmed, and over time, you'll grow comfortable navigating market ups and downs. Not only that, but consistency beats perfection every time. Many new investors waste time searching for the perfect stock or waiting for the right moment to enter the market. The truth is, waiting for perfection often leads to missed opportunities. What truly matters is contributing regularly to your portfolio. Whether you're investing $20, $100, or $500, staying consistent will yield better results over time than trying to time the market. Each contribution adds momentum, allowing compounding to work its magic. Market swings also present opportunities. Downturns, while intimidating, often allow you to buy quality stocks at discounted prices. Having a plan in place, such as maintaining a cash reserve for these moments, lets you capitalize on these opportunities instead of fearing them. These dips are when disciplined investors often see the greatest rewards. In investing, doing something, even if it's small, is far better than doing nothing. A clear plan, rational decision-making, and consistent actions are all you need to handle market swings effectively. Dividend investing, building consistent income. What sets dividend investing apart is its dual benefit. Not only do you receive regular income through dividends, but many dividend-paying companies also experience stock price appreciation over time. These companies are typically well-established and financially stable, with a strong history of profitability. For example, businesses in sectors like utilities, consumer staples, and healthcare are often known for their consistent dividend payouts. These companies generate steady cash flows even during economic downturns, making them reliable choices for investors looking to weather market volatility. The concept of dividend growth is another critical component of this strategy. Dividend growth refers to companies that not only pay dividends consistently, but also increase their payouts year after year. This growth is vital for protecting your income against inflation, ensuring that your purchasing power doesn't erode over time. For example, if you own a stock that pays a dividend of $2 per share today and increases it by 5% annually, that dividend will grow to $3.21 per share in 10 years. This raise in your passive income occurs without requiring any additional investment from you. One of the biggest advantages of dividend investing is reinvestment. Instead of cashing out your dividends, you can use them to buy more shares of the same stock. This leads to compounding, where your new shares also earn dividends, which then buy even more shares, and the cycle continues. For example, let's say you own 100 shares of a stock that pays $1 per share in dividends each year. That means you earn $100 in dividends. Instead of taking the cash, you reinvest it and buy more shares. Next year, you'll have more shares earning even more dividends. Over time, this snowball effect can turn a small investment into a massive passive income stream. Many brokerages offer automatic dividend reinvestment plans, or DRIPs, making it easy to set and forget, so your money keeps growing without extra effort. In the end, I will show you how this drip strategy can turn a $9 daily investment into a $2.5 million portfolio that pays $5,000 in dividend income every month. Developing your investing strategy. Investing isn't a one-size-fits-all journey. Your financial goals, risk tolerance, and timeline will shape the investing strategy that works best for you. Developing a well-thought-out plan tailored to your unique needs is critical to achieving consistent growth and building long-term wealth. One of the most established strategies is value investing, which involves identifying undervalued stocks trading below their intrinsic value. These stocks might be overlooked by the market due to temporary setbacks or broader market trends. Value investors like Warren Buffett look for strong companies with solid fundamentals, such as low debt, consistent earnings, and a competitive advantage, but whose stock prices don't reflect their true worth. The key to value investing is patience. You're betting that the market will eventually recognize the stock's true value, leading to substantial gains. Growth investing, on the other hand, focuses on companies that are expected to grow their revenues and earnings at a faster rate than the market average. These companies often reinvest their profits into expanding their business rather than paying dividends. Think of tech giants like Amazon or smaller startups revolutionizing industries. Growth stocks often have higher price-to-earning ratios, reflecting investors' optimism about future potential. While growth investing can deliver impressive returns, it comes with higher risk, as these stocks can be more volatile and may underperform during economic downturns. For those looking for a more hands-off approach, passive investing is an excellent option. Passive investing focuses on tracking the performance of a broader market index, such as the S&P 500, through exchange-traded funds or ETFs or index funds. These funds offer instant diversification, low fees, and consistent performance over time, making them a popular choice for long-term investors. Rather than picking individual stocks, passive investors rely on the overall growth of the market, which historically has delivered strong returns. This strategy is ideal for individuals who want steady growth without the time and effort of researching individual companies. Dividend investing is another widely adopted strategy, particularly for those seeking regular passive income. This approach focuses on investing in companies that pay consistent and often growing dividends. Dividend-paying stocks, such as those in the utilities or consumer staple sectors, provide a steady income stream while also offering the potential for capital appreciation. Reinvesting dividends can amplify returns through the power of compounding. Dividend investing is particularly appealing for retirees or those looking to create a predictable income stream without selling off their assets. For experienced investors willing to embrace risk, volatility investing can be an exciting and profitable strategy. This approach involves taking advantage of price fluctuations in highly volatile stocks or sectors. Volatility investors often use options, leveraged ETFs, or other financial instruments to profit from short-term movements. While this strategy can deliver high returns, it requires a deep understanding of market dynamics and the ability to act quickly. It's not recommended for beginners or those with low risk tolerances, as losses can accumulate rapidly. Selecting the right strategy depends on your individual financial goals and comfort with risk. If your goal is to build wealth slowly and steadily, passive investing or dividend investing may be the best fit. These strategies emphasize long-term growth and stability, making them suitable for risk-averse investors or those new to the stock market. On the other hand, if you're aiming for higher returns and are comfortable with more risk, value or growth investing might align better with your objectives. For those looking to take advantage of short-term opportunities, volatility investing offers an advanced, albeit risky, approach. Diversification is essential. Regardless of your chosen strategy, combining different approaches can help you balance risk and reward while taking advantage of various market opportunities. For example, you might allocate a portion of your portfolio to dividend-paying stocks for stability and passive income, invest in growth stocks for higher returns, and hold ETFs for broad market exposure. This mix allows you to capitalize on the strengths of multiple strategies while mitigating the weaknesses of any single approach. Setting clear, measurable goals is another important step in developing your strategy. Ask yourself what you want to achieve with your investments. Are you saving for retirement, building an emergency fund, or creating passive income? For this video, I will be combining value investing with a dividend investing strategy. I will show you how Buffett selects his stocks. In the end, I will show you a portfolio of stocks that will help you reach a $2.5 million valuation and earn $5,000 in monthly dividend income, all with just a $9 per day investment. Developing your investing strategy is a personal journey. Whether you're aiming for slow, steady growth, consistent income, or high-risk, high-reward opportunities, the key is to stay disciplined and aligned with your financial goals. With the right plan, a commitment to consistency, and a willingness to adapt, you can build a portfolio that not only meets your needs, but also grows with you over time. With all that, let's shift our focus to stock selection criteria, which is based on Buffett's 5 rules of thumb, which combines dividend investing and value investing strategies. To understand this, you need to understand some basics about the balance sheet. The balance sheet is one of the most valuable tools for analyzing a company's financial health. It provides a snapshot of everything a business owns, assets, owes, liabilities, and what's left for shareholders, equity. At its core, the balance sheet follows a simple equation: assets equals liabilities plus shareholders' equity. This equation shows how a company funds its operations, whether through borrowing, liabilities, or investment from shareholders, equity. For Warren Buffett, the balance sheet shows a company's true financial position, how stable it is, how much it relies on debt, and how effectively it reinvests profits. Over decades of investing, Buffett developed 5 simple yet powerful rules of thumb to evaluate balance sheets and identify companies built to last. Why these rules matter? Each rule serves a unique purpose, but together they provide a holistic view of a business. At the heart of this strategy is a focus on long-term stability, resilience, and growth. Buffett doesn't just look for companies that perform well in good times, he seeks businesses that can weather economic downturns and emerge stronger. Let's explore these rules in detail. The first and most fundamental rule is having more cash than debt. A company's total cash and short-term investments should exceed its long-term debt, ensuring financial flexibility and resilience. Businesses with strong cash reserves can navigate economic downturns, invest in growth, and operate independently without the burden of excessive debt. In contrast, companies with high debt levels may struggle during recessions, as interest payments and liabilities can hinder their ability to stay afloat. Closely related to this principle is maintaining a low debt-to-equity ratio. Buffett prefers companies with a DE ratio below 0.8, as it indicates financial discipline and a sustainable capital structure. Excessive reliance on debt makes businesses vulnerable to economic volatility and rising interest rates. While industry norms vary, utilities often carry higher debt than technology firms. A company operating within a reasonable range for its sector demonstrates prudent financial management. Another key criterion is avoiding preferred stock. Preferred stock, a hybrid of debt and equity, is often issued by companies in need of financing but unwilling to take on traditional loans. Buffett sees this as a red flag, suggesting financial instability. Strong businesses generate sufficient profits and secure funding through equity financing rather than resorting to expensive alternatives like preferred stock. Beyond financial stability, Buffett also looks for positive retained earnings growth. Retained earnings represents the profits a company reinvests after distributing dividends. Companies that consistently grow their retained earnings, even during economic downturns, exhibit resilience and profitability. This metric signals an ability to reinvest in innovation, expansion, and long-term value creation. And finally, Buffett views the presence of treasury stock, shares repurchased by the company, as a positive indicator when executed strategically. Thoughtful stock buybacks signal management's confidence in the company's value and demonstrate a surplus of cash. By reducing the number of outstanding shares, buybacks increase the value of remaining shares, ultimately benefiting long-term shareholders. Warren Buffett's 5 rules of thumb for analyzing a company's balance sheet are more than theoretical. They are practical tools that can be applied to real-world examples to evaluate a company's financial health. Now, let's apply these rules to a real-life company and see if it is a good fit for our portfolio. I am taking Microsoft Corporation with ticker symbol MSFT as an example. A globally renowned technology company with one of the strongest balance sheets in the market. By walking through each of Buffett's rules, you'll see how they highlight Microsoft's financial strengths and if the company aligns with Buffett's long-term investment philosophy. Buffett's first rule is simple yet powerful. A company's total cash and short-term investments should exceed its long-term debt. This ensures the company has sufficient liquidity to weather economic downturns, fund innovation, and seize growth opportunities without over-reliance on borrowing. For that, search FinChat. Go to Balance Sheet. As of its latest balance sheet, the company holds $78.4 billion in total cash and short-term investments, compared to $42.9 billion in long-term debt. That's a cash-to-debt ratio of nearly 1.8, meaning Microsoft has nearly twice as much cash as debt. This financial position gives Microsoft unparalleled flexibility. It can pursue strategic acquisitions, invest in groundbreaking technologies, or navigate uncertain economic conditions without taking on additional debt. Furthermore, this liquidity minimizes the company's vulnerability to interest rate hikes or financial strain during market downturns. For investors, Microsoft's adherence to Buffett's first rule signals a rock-solid foundation for long-term stability. Buffett's second rule is low debt-to-equity ratio. The debt-to-equity ratio measures how much of a company's funding comes from debt compared to shareholder equity. Buffett favors a ratio below 0.8, as it reflects financial discipline and reduced reliance on borrowing. Go to Ratios and click on Financial Health. Here you will see Debt-to-Equity Ratio. Microsoft excels here, with a debt-to-equity ratio of 0.3, far below Buffett's threshold. This means the company primarily finances its operations through equity rather than debt. For investors, a low DE ratio is crucial because it indicates that the company is not over-leveraged and can sustain growth without accumulating excessive liabilities. It also reduces risks associated with rising interest rates or economic downturns, where companies with high debt often struggle. Microsoft's DE ratio reflects a disciplined and sustainable financial structure, making it a standout in this category. Third rule is no preferred stock. It is a hybrid financing tool that combines elements of debt and equity. Companies issue preferred stock when they need funding but don't want to take on traditional loans. However, Buffett views this as a red flag because it often signals financial weakness or inefficiency in raising capital. Microsoft's balance sheet shows no preferred stock, listed in the equity section, aligning perfectly with Buffett's standards. This absence reflects the company's financial strength and independence. Rather than relying on costly or unconventional financing methods, Microsoft raises capital through retained earnings or common equity. The lack of preferred stock also aligns with Buffett's preference for businesses that operate from a position of stability and confidence. For investors, this reinforces Microsoft's reputation as a financially sound company that doesn't compromise its balance sheet integrity. Once again, Microsoft comfortably passes Buffett's third rule. Fourth is positive retained earnings growth. It represents the profits a company reinvests into its business after paying dividends. Buffett views consistent growth in retained earnings as a critical indicator of profitability and resilience, particularly during challenging economic periods. Microsoft's retained earnings tell a compelling story of consistent and robust growth. In 2020, the company reported retained earnings of $34.6 billion. By 2023, this figure had grown to $118.8 billion, and most recently, it stands at an impressive $188.9 billion. This upward trajectory highlights Microsoft's ability to generate substantial profits and reinvest them strategically into its operations, innovation, and future growth. Even during periods of economic uncertainty, Microsoft has maintained this growth, showcasing its resilience and smart financial management. For investors, retained earnings growth is a sign of a forward-thinking company that prioritizes long-term value creation. Microsoft passes this rule with flying colors. The last rule is the presence of treasury stock. It refers to shares that a company has repurchased from the market. Share buybacks are often seen as a sign of confidence, signaling that management believes the company's stock is undervalued and wants to return value to shareholders. Buffett appreciates companies with treasury stock as it reflects shareholder alignment. Interestingly, Microsoft reports no treasury stock on its balance sheet. While this might seem like a deviation from Buffett's preferences, Microsoft takes a different approach to rewarding shareholders. Instead of focusing heavily on buybacks, the company prioritizes consistent dividend payments and strategic investments in growth opportunities. This balanced strategy ensures that Microsoft delivers value to shareholders while maintaining its financial flexibility and avoiding the risks associated with excessive buybacks. For Buffett, the absence of treasury stock doesn't disqualify Microsoft. Instead, it highlights the company's disciplined financial management and focus on sustainable growth. By balancing shareholder returns with long-term investments, Microsoft aligns with the principles underlying Buffett's fifth rule. Now, by understanding the rules of Buffett, let's select the remaining 4 stocks and build a portfolio. Building a portfolio to generate passive income. Building a portfolio that generates $5,000 in monthly dividend income requires a strategic combination of high-quality dividend stocks, consistent reinvestment, and a focus on long-term growth. By applying Warren Buffett's rules for balance sheet analysis, I have shortlisted 5 companies that stand out for their financial health, growth potential, and commitment to shareholder returns. These stocks, when combined, create a well-diversified portfolio that balances dividend income with significant capital appreciation. The first stock in this portfolio is Prologis, with the ticker symbol PLD, a leader in logistics and industrial real estate. Its properties are the backbone of modern supply chains, serving some of the world's largest companies as they store and move goods efficiently. Prologis is known for its strong dividend performance, underpinned by a business model that thrives on long-term lease agreements with high-quality tenants. As e-commerce continues to expand, the demand for Prologis' properties remains strong, making it a reliable player for steady income and growth. Prologis offers a strong dividend yield of 3.17%, a steady dividend growth rate of 11.27%, and an annual share price appreciation of 9.95%, making it a reliable choice for consistent income. Next, Microsoft Corporation with the ticker symbol of MSFT. I added this because 1. It is one of the most innovative and dominant technology companies in the world, and second, we just saw it check Buffett's all 5 criteria for a perfect long-term stock. Known for its software products like Windows and Office, as well as its cloud computing platform Azure, Microsoft has built a robust ecosystem that spans business, consumer, and enterprise solutions. Its consistent dividend payouts reflect the company's commitment to returning value to shareholders while maintaining a focus on growth through reinvestment in groundbreaking technologies. Microsoft's strong financial foundation and ability to innovate make it an anchor for any long-term investment portfolio. Microsoft's dividend yield of 0.75% may seem modest, but its impressive dividend growth rate of 10.35%, coupled with an annual share price appreciation of 21.57%, ensures exceptional returns over time. Another strong addition is NetEase with the ticker symbol of NTES. It is a major player in the Chinese technology sector, focusing primarily on gaming, online education, and e-commerce. Its diversified portfolio of digital services and its leadership in mobile gaming makes it a compelling growth story. NetEase has consistently rewarded investors with dividends, which are supported by the company's strong revenue growth and expansion into emerging industries. With its commitment to innovation and market dominance in its niches, NetEase is well positioned to deliver long-term value. NetEase combines a dividend yield of 2.4% with a dividend growth rate of 17.29% and an annual share price appreciation of 16.9%, making it an excellent choice for balancing income and growth. Federal Agricultural Mortgage Corp Class C with the ticker symbol of AGM, also known as Farmer Mac, provides credit to the agricultural sector, helping farmers in rural communities access the financing they need. Farmer Mac operates in a vital sector that is often overlooked but essential to the economy. Its focus on agricultural loans ensures steady cash flow and low-risk lending practices, making it a stable and dependable choice for dividend investors. Farmer Mac's strong financial management and emphasis on growth in rural America reinforce its value as a long-term income generator. With a dividend yield of 2.82%, an impressive dividend growth rate of 25.89%, and an annual share price appreciation of 17.35%, it delivers both steady income and outstanding growth potential. Finally, Home Depot with the ticker symbol of HD is the largest home improvement retailer in the United States, catering to both professional contractors and DIY enthusiasts. With a vast network of stores and an ever-growing online presence, Home Depot continues to benefit from the ongoing demand for home renovation and construction projects. Its consistent dividend payments are backed by a solid track record of profitability and growth, reflecting the company's ability to adapt to changing consumer needs. Home Depot's reliable business model and leadership in its sector make it a valuable component of this portfolio. With a dividend yield of 2.12%, a dividend growth rate of 16.95%, and an annual share price appreciation of 13.8%, Home Depot provides consistent income and stability. Each of these stocks plays a unique role in building a balanced, high-growth dividend portfolio. Prologis provides stable real estate-backed income fueled by e-commerce expansion. Microsoft offers innovation-driven growth with steady dividends and market dominance. NetEase adds high-growth potential in the booming tech and gaming sectors. AGM ensures steady cash flow from the essential agricultural finance industry. Home Depot contributes resilient consumer-driven stability with consistent dividend growth. Together, they create a diversified portfolio, blending dividend security, capital appreciation, and sector-specific growth to maximize long-term returns. When combined, these 5 companies create a powerful portfolio with a current dividend yield of 2.25%, an average dividend growth rate of 16.35%, and an annual share price appreciation of 15.91%. Now that you have made a portfolio, it's time to know how much it can pay after applying all the strategies we have discussed so far. Let's say you or Josh invest $9 a day into this portfolio. Here's how it's expected to grow over time. In the first year, your daily investment would accumulate to $3,285. By year 10, the portfolio will grow to $78,000, with dividends starting to make an impact. At this stage, compounding begins to accelerate, driving steady growth. Give it 10 more years, and by year 20, the portfolio will reach $498,000, with annual dividends climbing significantly, contributing a substantial portion to the reinvested growth. By year 30, the portfolio value will soar to $2,782,000, generating $60,000 annually, or about $5,000 per month in passive income. Reaching a $5,000 monthly dividend income target is no small feat, but this portfolio proves it is achievable with discipline and a long-term perspective. Each stock was chosen for its alignment with Buffett's rules, focusing on liquidity, low debt, profitability, and shareholder alignment. This ensures that the companies in the portfolio are built on strong financial foundations, capable of sustaining growth and weathering economic challenges. This portfolio not only meets its income goal, but also provides a blueprint for how strategic investing can deliver financial independence. By staying consistent, reinvesting earnings, and focusing on high-quality companies, you can create a portfolio that grows steadily and provides a reliable income stream for years to come. Here's a quick recap of how we've built a plan for achieving financial freedom through smart investing. We started with the basics, like understanding dividend stocks, key metrics, and how to evaluate companies using Buffett's timeless rules. From there, we explored strategies like value investing, passive investing, and dividend reinvestment, showing how they work together to grow wealth over time. Finally, we applied these principles to a real portfolio of 5 stocks, projecting it to grow into a $2.8 million powerhouse that generates nearly $5,000 in monthly passive income. Want to know how to turn a $50 or $150 weekly portfolio into one that pays over $20,000 in monthly dividend income? Click the video on screen to find out.